Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're kicking off with a topic that's on the minds of many Canadians, the upcoming mortgage renewal storm and how banks are bracing for it. It's been reported that by the end of 2026, nearly half of Canadian homeowners will face mortgage renewals with payments expected to spike by an average of $400 per month. This could be quite a shock to many households, don't you think, Sandy?
Absolutely, Steve. It's a significant increase, especially for those who locked in lower rates during the pandemic. But it seems like the banks are staying optimistic. They've expressed confidence that strong borrower equity and the decreasing interest rates will provide some cushion for households. What are your thoughts on that?
Well, Sandy, while the banks are putting on a brave face, the numbers show some stress is already evident. For instance, Canadian Imperial Bank of Commerce has reported a rise in its mortgage delinquency rate to 36 basis points. And the Bank of Montreal has noted that its provisions for impaired loans remain elevated at 45 basis points. These figures suggest that not everyone is sailing smoothly through this period.
Right, Steve. And it's not just the numbers that are concerning. There are specific regions like Windsor that are feeling the pressure due to a slowdown in the auto sector, which is impacting household budgets. However, on a broader scale, banks like Toronto Dominion Bank are highlighting that a significant portion of their customers might actually see their payments decrease upon renewal. It seems like a mixed bag, doesn't it?
Indeed, Sandy, the picture isn't entirely bleak. Toronto Dominion's Chief Risk Officer, Ajay Bambawale, mentioned that about 64% of their customers are expected to see their payments decrease, which is quite reassuring. For those who will experience an increase, the impact is anticipated to be manageable, equating to about 3.5% of household income. The banks are also leaning on strong home equity and solid credit profiles to buffer against the storm.
That's a great point, Steve. Home equity has been a key factor in providing a safety net. Many Canadians, especially those with uninsured mortgages, have built up substantial equity. For example, Canadian Imperial Bank of Commerce's Chief Financial Officer, Rob Sedran, pointed out that their average loan-to-value ratio on uninsured mortgages is just above 50%. That's a lot of room to absorb potential financial hits.
Exactly, Sandy. And from a credit perspective, the banks are in a solid position too. Royal Bank of Canada, for instance, boasts an average credit score across its mortgage book that's close to 800. This indicates a strong repayment ability among borrowers, which is crucial during these times of financial uncertainty.
Definitely, Steve. It's clear that while there are significant challenges ahead, there are also factors in place to mitigate the impact. As banks navigate this renewal cycle, they're focusing less on expanding market share and more on maintaining strong credit standards and healthy margins. It'll be interesting to see how these strategies play out as we move forward.
Let's dive into the latest decision by the Bank of Canada to cut its benchmark rate to 2.25%. This move, announced by Governor Tiff Macklem, is being welcomed as a positive development for the Canadian housing market. It's a step that could potentially boost confidence among homeowners and prospective buyers.
That's right, Steve. This rate cut is the 9th reduction in the past 16 months, which means we've seen a total decrease of 175 basis points since June of last year. Crystal Lee, Assistant Vice President of Real Estate Secured Lending at TD Bank, highlighted that this cut suggests rates are stabilizing, which is certainly good news for Canadians contemplating home purchases.
Exactly, Sandy. Lee mentioned that the decision is a relief for many Canadians who have been hesitant to make significant purchase decisions due to higher borrowing costs. With the cost of borrowing lowered, there's an opportunity for those who've been on the sidelines to enter the market, potentially increasing home buying activity in the coming months.
And for those facing mortgage renewals, this quarter point cut is also a welcome development. It eases some of the fears of a renewal cliff that had loomed large due to earlier rapid rate hikes meant to curb inflation. While payments will still be higher for many who took out mortgages during the pandemic, the situation isn't as daunting as it was.
Absolutely. Lee pointed out that a recent TD survey shows Canadians are taking a more thoughtful approach to their finances amid these economic challenges. About 73% of respondents are focusing on cash flow management, considering reductions in non essential spending, and even drawing from investments to manage payments despite the rate reductions.
That's a prudent approach, Steve. However, it's interesting to note that despite the rate cuts, many Canadians are still gravitating towards fixed rate mortgages. Lee observed that about 75% of renewers are opting for fixed rates for the security and consistency they offer, despite the dip in variable rates.
It's a reflection of the broader economic uncertainties, Sandy. Economists like Benjamin Tal from the Canadian Imperial Bank of Commerce have raised concerns that Canada's economy might be in a worse position than official figures suggest, potentially even entering a recession. This uncertainty likely drives the preference for fixed rate stability.
Indeed, Steve. While the Bank of Canada's rate cuts have provided some relief, the ongoing trade tensions with the United States and other economic pressures continue to create a challenging environment. It's crucial for homeowners and buyers to remain informed and adaptable as they navigate these waters. Let's turn our attention to the recent movements in the Canadian 10-year bond yield. It seems that yields have eased back toward 3.1% after a brief rebound from their lows in April. This shift appears to be driven by incoming growth data, which has undercut the previous support from the Bank of Canada's actions. Steve, what's your take on these developments?
Well, Sandy, the Bank of Canada's recent 25 basis point cut to 2.25% was initially a positive signal for yields. However, the economic data tells a different story. September's GDP did rise by 0.1% month over month, but the flash estimate for the third quarter is also just 0.1%. More concerning is the revision of August's GDP to a 0.3% contraction, marking the largest monthly drop since December 2022. This suggests that trade frictions and higher policy rates are exerting a more significant drag on growth than anticipated.
That's right, Steve. It's clear that the market's focus has shifted back to the risks of downside growth. The cooling labor market and softer economic activity are definitely pulling the 10-year yield lower. But there's also the issue of inflation, which remains sticky. The headline consumer price index is around 2.4% year over year, and the bank's trimmed measure is near 3.1%, complicating the policy trade-off. How do you see this affecting the bank's future decisions?
The Bank of Canada is in a tough spot, Sandy. They need to balance the need to support the economy with the need to keep inflation in check. With inflation still above target levels, they might have limited room for further rate cuts. Meanwhile, the softening economic indicators suggest that the cautious path they've chosen might be necessary to avoid exacerbating economic slowdowns. It's a delicate balancing act, and it'll be interesting to see how they navigate it moving forward.
Indeed, Steve. On the trade front, there's also some movement. Prime Minister Carney's recent meeting with China's President Xi Jinping to restart economic engagement is a step in the right direction. The goal to double non-U.S. exports over the next decade could provide a much-needed boost to the economy. But these are long-term plans, and it'll take time to see their impact. Meanwhile, the immediate focus will likely remain on managing the current economic challenges.
Absolutely, Sandy. The trade ambitions are promising, but as you said, they're not a quick fix. Right now, the market's looking for signals of stability, especially with the ongoing trade tensions and domestic challenges. It'll be crucial for policymakers to maintain clear communication and steady strategies to reassure investors and the public alike.
In an interesting development, Canada's construction industry has managed to outpace the broader economy, showing a growth of 0.24% in the second quarter of 2025. This is according to the latest report from the Canadian Construction Association. It's quite a feat considering the national economy actually contracted over the same period. Steve, what do you make of this resilience in the construction sector?
It's impressive, Sandy. The sector's growth seems to be largely driven by ongoing federal infrastructure initiatives, which have provided a cushion against the broader economic downturn. However, industry leaders are highlighting some challenges, such as rising costs, labor shortages, and evolving trade policies that are complicating project delivery. These are significant hurdles for the industry to overcome.
Absolutely, Steve. Rodrigue Gilbert, the president of the Canadian Construction Association, mentioned that while the industry is benefiting from the federal government's nation-building focus, these challenges are making it harder for companies to plan, bid, and deliver the projects that Canadians rely on. It's a complex situation.
That's right, Sandy. A particular point of concern is the upcoming Buy Canadian procurement rules for federal projects, which are set to take effect in November. While these rules are intended to boost domestic suppliers, there's a worry that they could disrupt project timelines and increase costs if not implemented with adequate industry input. Rodrigue Gilbert emphasized the need for coordinated trade, procurement, and investment policies to make building easier, not harder.
It's a delicate balance, Steve. On the housing front, the report hints at a potential modest improvement in residential construction later in 2025, thanks to anticipated Bank of Canada rate cuts and the federal Build Canada Homes initiative. However, Governor Tiff Macklem has indicated that further rate reductions are unlikely unless the economic outlook shifts dramatically.
Indeed, Sandy. While the Bank of Canada recently trimmed its key overnight rate to 2.25%, marking its second consecutive cut, the path to a sustained recovery in residential construction might still be uneven. The Canadian Construction Association noted weaker pre-sales and pronounced regional disparities, particularly in Ontario and British Columbia, as factors that could temper any rebound.
And yet, there's some positive news on the home construction front. Canada's new home construction rebounded in September, with housing starts rising by 14% from the previous month. This pace surprised many economists and signals ongoing resilience in the face of challenging market conditions. The Canada Mortgage and Housing Corporation reported a seasonally adjusted annualized rate of 279,234 units, which is quite substantial.
It certainly is, Sandy. Economists had expected a more modest increase to around 255,000 units, so this uptick is encouraging. It shows that despite the challenges, there is potential for growth and resilience in the market. But as always, it's crucial for industry stakeholders to remain vigilant and adaptable to navigate these complex dynamics effectively.
In our last segment today, let's dive into a promising development in Stouffville's housing sector. The town is advancing its Affordable Housing Community Improvement Plan, or CIP, which is set to be presented in a public meeting next month. The plan aims to introduce both financial and non-financial incentives to boost housing construction in the area. Steve, what are your thoughts on this initiative?
Sandy, this initiative is quite timely, given the current slowdown in the housing market. It's funded through the Housing Accelerator Fund and proposes several programs like fee waivers, grants for additional residential units, and even property tax relief. These are designed to lower construction costs and encourage builders to develop more affordable housing options.
Absolutely, Steve. The town's approach is comprehensive, with incentives like the ARU and multiplex creation grants, offering up to $11,000 for new or converted units. They've also included an accessible design top-up, which encourages builders to go beyond the provincial building code requirements for accessibility. It's a thoughtful way to ensure inclusivity in new developments.
It's a smart move, Sandy. And beyond financial incentives, the non-financial tools like the surplus lands policy and ARU design guides are also noteworthy. These initiatives are crucial for supporting growth without incurring upfront costs. By potentially leasing or selling municipal land below market value, the town is setting a solid foundation for affordable housing.
That's right, Steve. The town's efforts are a part of a broader push by various government levels to address the challenges in the housing construction sector. Ontario and Ottawa are also stepping in with tax rebates for first-time homebuyers. These rebates could provide significant savings, making homeownership more accessible.
Exactly, Sandy. The Ontario government announced a tax rebate for first-time homebuyers, which, when combined with the federal government's rebate, could result in total savings of up to $130,000 for new home purchases. This is expected to invigorate the housing market by encouraging both builders and buyers to engage more actively.
It's encouraging to see these coordinated efforts. The federal government's rebate alone is projected to deliver $3.9 billion in tax savings to Canadians over 5 years. And with the Ontario rebate, it looks like the market might regain momentum, allowing young families to move into homes and builders to meet the revived demand.
Indeed, Sandy. As Minister Rob Flack mentioned, the aim is to restore confidence in the market. By removing uncertainties, builders can focus on selling their current stock and gearing up for new projects. It's a strategic approach that could lead to a more vibrant housing sector in Ontario.
Let's hope these measures have the intended effect. It's clear that the town of Stouffville is committed to creating a diverse and sustainable community. With these initiatives in place, we might see a more inclusive housing landscape in the near future.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.